Is your corporation as tax efficient as it should be? At a very basic level, you should be keeping funds inside your corporation, and those funds should be invested in order to take advantage of the tax rate difference between corporate and personal. But also, CRA looks at investment income as being passive income, and that passive income is being taxed at 50%. First dollar is taxed pretty much at 50%. Now, to make things worse, in the last budget, which was just passed, capital gain inclusion rate has been increased to 67%. This is effective June 25th, 2024, so pretty much immediately. And on top of that, about 3 years ago, there was a change where now any passive income over $50,000 inside your corporation will reduce your small business tax rate in the future years. And when you have passive income over $150,000 in your corporation, your small business tax rate is reduced down to 0. You need to be tax efficient inside your corporation, specifically when it comes down to investments. But unfortunately, very few business owners are actually implementing or taking advantage of all the solutions out there. One of those solutions, which is very, very effective, is an estate bond or corporately owned estate bond, which is essentially an insurance. It's an insurance contract with an investment account around it or within it. And it allows you to move funds from taxable environment into essentially tax-free environment, almost like a tax-free savings account inside your corporation. But there are no dollar limits on an estate bond. So it could be a $500,000 estate bond or $5 million or $50 million. It just depends on how big the corporation itself is. It has to be set up correctly where the corporation is the owner, corporation is the beneficiary, and the business owner is the life insured. And essentially the strategy lets you use the estate bond as collateral and therefore potentially pull funds out of the corporation on a tax-free basis to fund business owners' retirement. And when the business owner ultimately passes on, any residual market value inside that estate bond will flow out through the capital dividend account on a tax-free basis. Let's quickly look at a case study. We have Jeff here with Jeff INC. And inside his corporation, Jeff has $1 million portfolio. This $1 million portfolio is expected to grow to 2.396 million in 15 years, assuming 6% return after tax. Now at 2.396 million, the portfolio will be producing more than 150,000 in passive income. So what we suggested was, Jeff, why don't we move this million into an estate bond over the next 15 years? So essentially, Jeff will make a deposit, $75,000 annually, into the estate bond, which is tax-free environment versus fully taxable environment on the other side. And the estate bond, 15 years out, market value of that estate bond will be $3.2 million. So again, 3.2 million, 15 years out, 0 passive income being generated. And now Jeff will have the ability, if he wants to retire at that point, to fund part of his retirement by using the estate bond as collateral. And when he ultimately passes on, anything that is left in the estate bond will pay off, first of all, the loan, and then the rest will go to his beneficiaries on a tax-free basis. If you do have funds inside your corporation, if you do have passive income inside your corporation over $50,000, you need to give me a call or please send me an email. I'd be happy to explain further. Please like the channel, please subscribe to the channel, and see you next time.